Hello, everyone. I assume there's people at home. There's just a few in the class due to the weather. I'm going to back up a little bit from where I stopped last week because it's important to understand what a big deal September 2008 was, and allowing the Lehman Brothers bankruptcy and how it changed things, how it changed monetary policy, how it affected interest rates. It's remarkable in terms of how enormous the changes were. And one of the ways you see those changes is you look at what is called the Fed's balance sheet. The Fed has a balance sheet just like a household has a balance sheet, just like any financial institution has a balance sheet of assets and liabilities. And that's what we're going to walk through. And liabilities are all tied to currency and the creation of money supply. So the first thing we do is measure the monetary base, which is what something they have direct control over, its currency and reserves. And the purpose of showing you this at the end of the last session was to show you just in terms of how the system worked in terms of liabilities and creation. This goes back to 1962. And you can see the creation of currency as the economy grows. There's more people, more population. You need more currency in the system just to keep things going. And as you can see, the reserves in the system were relatively small. In 2008, the liability side of the balance sheet changed dramatically. And how did it change dramatically? Well, it wasn't really about currency. If you go back, you can see currency grew a little bit, but currency wasn't the big grower. The big grower is this thing called excess reserves. And what is the concept of excess reserves? Banking institutions have a requirement to post certain amount of reserves based on the size of their deposits in Federal Reserve banks. And up to 2008, excess reserves were really tiny. And that's why they didn't show up in the prior graph. You can't see them. They're in there, but they're really tiny. And then what happened? We had this event called a financial panic that occurred because of the Lehman Brothers bankruptcy. And the Federal Reserve started to increase the money supply and the monetary base through its activities in the bond market, providing so much funding out there that the banks couldn't lend it out fast enough. So they parked the money in the Federal Reserve banks, way exceeding anything that would have been required based on the size of their deposits. And that's this big hunk of red, and it coincides with some dramatic changes in the way the entire economy has been managed and the influence of interest rates. Good. That was the political argument at the time. The argument was the reason the recovery after the financial panic was so weak was because banks were sitting on all these funds and they were not lending them out. And the answer is banks were sitting on funds and not lending them out, but that's not why the economy was so weak. I'll show you some stuff on that issue. Yes. Ah, that's not reserves. The question was due to stress tests, weren't there increases in things that the biggest banks had to do? And the answer, if they didn't meet certain stress tests, they had to increase capital. Capital is not reserves. Reserves are cash deposited. Capital is as a measure of the overall position of assets minus liabilities in a bank, as you'll see in a minute. But there's something very special that occurred here. And I'm going to get into it in some detail later. And it has to do with a policy decision of the Federal Reserve, that a policy that was allowed by the it's in Dodd-Frank, where the Federal Reserve said, we don't want negative interest rates. Okay. And they changed how the entire Fed funds market worked. It went from a market indicator, because it was a borrowing and lending rate inside the banking institutions that could operate in the Fed funds market. They changed it to an administered rate, which is, what is the rate today? It is the rate that a committee at the Federal Reserve decided this is what the rate is. And the reason they did it is because if you put this kind of money into the financial system of the United States, it will drive interest rates down. And they were already in December of 2008, that was already at zero. And they needed to put more. The idea, you'll see when we talk about quantitative easing, as to what they were trying to do. But this is a reflection on the liability side of them doing it, which is they created tons and tons of cash that got into the banking system, and the banks parked it. And oh, by the way, then the pandemic hit, and what did they do again? Even though you're already up here at $2 trillion, they increased it again because of the concerns about the pandemic driving the economy into a hole. That was, believe it or not, that was a good thing. So if you look at this, how many different ways can I illustrate literally an existential revolution in terms of the management of money and money supply through the Central Bank of the United States, and other central banks have similar kinds of graphs. It's changed everything. And as you can see, this measure actually goes out to 2023. You can see that they're still there to this day. Okay, so this is the perspective of the flip side, and it is all related to this term called quantitative easing. And quantitative easing, really, what was it about? Quantitative easing, as you will see as we get into this in some detail, we don't want negative interest rates. Well, how has the Fed stimulated economic growth in the past? It's driven interest rates down. Well, if you say, sorry, we're not going to go any further, despite the fact the economy's in the tank, well, they innovated and bought into the idea of what the system needed money. There's no question about it in the late part of 2008 and 2009. But the rest of this is all about an unused, unresearched policy to say, well, the economy's weak in 2010, 2011, 2012. Our job is to provide stimulus because we're not getting the economic growth. So we're just going to keep putting money into the system. And hold on a second, where's the next graph? This is the other side. The liability side is currency, but how do they do that? Is they buy assets. And if you go all the way back to, this goes back to December 2002, you can see that in terms of what they needed to do to manage money supply, this was the level of treasuries and treasury bonds and interventions in the treasury bond market. This is how they operated. You're beginning to see this here. This green part here has to do with the failure of Bear Stearns and how the Fed helped and supported the buyout by J.P. Morgan Chase, and pops up. But this is the graph that tells you the revolution in monetary policy. Why? First, you can see in the data each of the steps of the quantitative ease, where they went one step, okay, that was quantity, that didn't do enough. This is quantitative easing. This is the step two. They issue a circular. They tell the market and tell the public, this is what we're doing. There are various the variants on the theme of exactly what they issued, but the essence of it was, you see this red part? That red part, those are mortgage-backed securities. That was never done before. They decided we don't want to own we want to own financial instruments, but we don't want to, we already own a couple of $1 trillion of treasury bonds. Oh, the mortgage market's weak. We've had the housing collapse in 2009 to 2010. Let's support it. We'll buy mortgage-backed securities. Now, it shouldn't take most people long to realize, well, wait a minute, wasn't the mortgage-backed security and the failures in the mortgage-backed security market contributors to the meltdown in 2008 and 2009? And absolutely they were. And you'll see in a graph later, you'll see that the Federal Reserve now is the largest holder of mortgage-backed securities in the world, and has been for some time. And what you see here is the one good thing that came out of the one very good thing, because it's learning by doing. You know, they had never done this before, so they didn't have a lot of history to look at. It was, let's try it and see what happens. Let's try it some more and see what happens. And so they're thinking in 2017, Janet, they announced the policy. They're very slowly going to reduce their overall position in the financial markets, their holdings of treasuries, their treasuries. And the way they do it is they don't really sell them. What they do is they allow them to mature, and they don't replace them with additional purposes. And this is exactly what they're doing. Very slowly. They didn't want to shock the markets. They just wanted to reduce their overall position. The pandemic hit, and they went, well, we did this, and it helped things. Let's do this. They literally, if you just look at this, if you look at their overall position in terms of their assets, it was a little under 5 trillion, and it peaked up here about $9 trillion. And look what they're doing now. They're very slowly and surely reducing their position by allowing their holdings to mature and not replace them. Yes. The green bar is, I mean, this is creating, they're called shelves, okay? And what the concept of shelf was, they wanted to provide liquidity into the system. So how do they provide liquidity into the system? They can't be direct lenders to, say, GE and non-financial corporations. So they create these, theoretically, these insulated entities, they're called shelves, to provide liquidity to help support borrowing in those markets. You may have seen or heard about in the movies where during the meltdown phase, GE called up Ben Bernanke. They had GE called up Ben Bernanke and said, guys, I just want you to know, we can't issue any commercial paper. There's nobody out there to buy it. And that's one of the things that happens in a financial panic. Everybody panics. Nobody's willing to lend. And this big green part here includes AIG and the bailout of AIG. And the rest of it is just a lot of instruments to ensure liquidity continues. And it doesn't really represent what really matters, which is their holdings of treasuries and their holdings of mortgage-backed securities. If you look at it, you'll see they created several different shelves to provide liquidity in different sectors of the market. It wasn't just commercial paper. If you Google Federal Reserve shelves, you'll end up learning more than you wanted to know. But it's a lot of details involving the Federal Reserve is not supposed to, by law, not supposed to take on credit risk. And so it has to get paid back. Even the mortgage-backed securities, it has an agreement with the U.S. Treasury. If there's some kind of default crisis on the mortgage-backed securities, the U.S. Treasury will make them whole in terms of how they structure this. Yes. 2007 meeting taking out these mortgage-backed securities really weren't qualified for the role. Yes. So what happened? Okay, so the question is, what makes mortgage-backed securities theoretically different now than what they were before? And the answer is, this is why And one of the reasons why you need federal regulation, which is the last two lectures of this course, in terms of understanding what was occurring in 2006. I mean, these stories that showed up in movies, the Big Short and the rest of them, where I should have gotten this thing. My son was at UCSC, and he said, "Well, what do you think, Dad? This guy wants to loan me money." I said, "Loan you money? You're a student at UCSC. You don't make any money." I should have known that was a signal that things had gone too far. And there's lots of anecdotal stories there of people who usually wouldn't qualify and maybe were naive and didn't even realize they were betting on interest rates in the economy in terms of how they were investing in, and it led to over leverage in that market, and that over leverage of the paper of loans, the loans that really were far more levered than people understood, they went into the mortgage-backed securities. And so when people stopped paying on those loans, it then spread to the mortgage-backed security market. So now you have much tighter controls over the loans feeding the mortgage-backed securities. And surely one of the ways the banks learn to control this after the fact, of course, is they get taken to court by the regulators, and they have to pay up for the mortgage-backed securities that melted down, misrepresentations that they didn't do due diligence. They misrepresented how potentially risky those loans. All these institutions. This is country. This is why Bank of America had trouble after it purchased Countrywide. Why? It inherited the liabilities of Countrywide that Countrywide created because of its own lack of controls over the paper it was originating for the mortgage-backed security market. So mortgage-backed securities per se have issues, but the real issues, they haven't shut down the mortgage-backed security market. Mortgage-backed security market is alive and well as we speak. Mortgage-backed security market, they exist. There's all kinds of things going on with mortgage-backed securities, but the difference is the paper that's going into these securities now is theoretically people, you can't get a loan with what do they call them, no income loans. You didn't have to prove your income. The due diligence wasn't done. Nobody was enforcing the rules, et cetera, et cetera. So the question is this something you should be alarmed at? What this is an illustration of is the following. If one had given a class in, say, 2007 and whispered into economists' ear, by the way, in several years, the Federal Reserve is going to be holding $9 trillion of securities in its vaults. What does that mean for inflation? An awful lot of them would have said, well, that inflation would be out of control. You can't do that in the system because all the models they had at the time that didn't include this particular kind of event wouldn't have indicated that. And the answer is inflation wasn't out of control until 2021, in large part due to the pandemic and many other factors. But the point is that when you look at this is an example of change, not an example to be alarmed about. And what they're doing here is it's policy insurance. They're saying it wouldn't be wrong for us to reduce our holdings over time very carefully. And that's exactly what they're doing. And they're doing it under scrutiny. They've made the announcement that that's their intention. And, as far as I know, this has not been the source of major disruptions in the financial markets. Yeah. Is there a question over here? Okay. Yes. 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 The way we'll get into the structure of a mortgage-backed security, but a mortgage-backed security has maturity dates and principal flows tied to the underlying loans and the maturity dates of the loans that are supporting that particular security, and they can get very complicated. Don't get me wrong; it's not like an individual loan. Yes. The big question. The failure of Lehman Brothers is still controversial as to what three human beings decided to do and decided not to do: Bernanke, Paulson, and Geithner. And the three of them have teamed up and so far convinced the world that they had, quote unquote, no choice, that they had to allow Lehman Brothers to go bankrupt. Uh, Laws have since been reformed so that hopefully that particular scenario won't come up. But someone else has written a book saying, "What are you talking about? Of course they had a choice." And so the controversy will be ongoing as to what could they have done, what should they have done. My own view is, given the costs of the bankruptcy in terms of the economy, which was huge, given both economically and politically, that given those costs, why not roll the dice and let them keep going? I mean, what potentially could have been the harm? And you could have restructured them. The Federal Reserve has all kinds of power. I mean, they let SVB go bankrupt. Uh, it's hardly noticed. I was more concerned about whether or not it was lead to contagion, which is part of the lecture next week, if not the last part of the last lecture. Uh-oh. Okay, it's locked. What happened? There we go. Okay. So here's the answer to your question. You read ahead. Perspective on could they have stepped up and bailed out? Yes. I am one of those who thinks they could have and they should have. Uh, there's no question that given the level of the panic, they should have intervened. And given what they've been doing, it's been learning by doing, and there's consequences associated with what they've been doing. And one of the consequences is, as you'll see in a minute, there is a huge disconnect now in the central banking operations. It used to be they had to worry about, gee, when they were buying a bunch of bonds, how was this going to affect long bond interest rates? If they weren't buying them, they had to worry about their management of the Fed funds market in terms of how it played out the bond market. And now it's disconnected. Now they can say anything they want regarding what the interest payment is on reserves. Yes. Ah, that is, yes. Others have. They haven't allowed deposit rates to go zero. That is a policy. That is a policy decision which I haven't seen any good explanation as to why they made it, other than saying, in order to avoid negative interest rates, we instituted this other policy. Absolutely. Okay. And you got to think about learning by doing in a major financial institution, the central bank. There is this concept that everybody in this course knows. It's called learning by doing. And they are learning by doing. And one of the benefits of them learning by doing is this. you know, they'd done this. They got to this. They saw the numbers coming out of the economy, and they said, "Well, we don't." What the essence of the discussions were at that time: we don't want this pandemic to lead to a financial panic. And so they decided intentionally, look at this graph, very quickly to put trillions of dollars into the banking system. And as a consequence, we did not have a financial panic. You cannot rewrite history to say, well, what if they hadn't done that? Would we had a financial panic? And of course, you can't answer those questions. So you look at the consequences, and these had macroeconomic consequences. They had macroeconomic consequences on interest rates. And that is really why understanding monetary policy is actually relevant to personal finance. I mean, all of this stuff is going on. all of it affects the interest rates you see, affects the stock market, any of the investments you personally may make. These things play out. And it begins with understanding this dual mandate. And it's a 1977 law. And it essentially says the Federal Reserve's there to maintain low unemployment rates and low inflation rates. That's their job. And trust me, even though most of the people on the board making decisions coming out of the Federal Reserve banks and all the rest of this stuff, they take this stuff very seriously. There's no question about it. They are guided by this is their responsibility. This is what they're there to do. And, besides, none of them want to be in a congressional hearing and say, have someone yell at them in public on TV saying you're not following the law. That's not a pleasant position to be in. So this is the guidance. This is really what they're doing. Well, it turns out that's a two-dimensional diagram. What's the two-dimensional diagram? It is, you got the unemployment rate down here. They've got targets, goals. Okay, what's the inflation rate? And you just look at it from a perspective of this two-dimensional diagram and you say, oh, well, we don't know exactly what the optimal low full unemployment rate is. It's about 4%, maybe a little bit less, maybe a little bit more. The measure changes over time. There's plenty of papers of people estimating and coming up with different numbers. So I put it as a gray zone around 4% unemployment. That leads to a target. Well, they've also magically told everybody and have acted accordingly. Their inflation rate, target inflation rate, is 2%. And you say, well, how are they doing? Well, this is the red. This is where they were in August 23. This is where they were in December 23. They are managing policy, managing interest rates in order to get somewhere into this zone here, which is what their job, which is what their job is. And the thing to know about inflation, and this is something that people really don't get. First, deflation in a modern capitalist economy with borrowing and lending going on, deflation, you don't want to experience it. Why? Well, suppose I told you that we had a deflation rate and you could buy what you've been putting off buying and you could get it for 10% less if you were willing to wait for 6 months. And what would you do? Most people would say, well, I'm just going to wait until the price falls. Yes. And that interrupts economic activity, and it's a real struggle for policymakers to get it out of there. So there's just general consensus that deflation is a really bad idea. It's bad for the economy. It's bad for the way things work. There's uncertainty. There's some uncertainty regarding exactly how we measure inflation. You really don't want it. Okay. Yeah, well, you'll see that one can argue about high inflation rates, what's too high, and eventually you get to levels, that are too high. You worry about hyperinflation. You remember the movies from Germany in the 1920s of people with wheelbarrows walking around with cash because the inflation rate's so high. And hyperinflations have certainly happened in developed economies. And I can't tell you what the magic number is, but just given the politics in the United States regarding a 10% or an 8% inflation rate in terms of how it's affected people, in terms of what they think is going on, there's a lot of negativity. In this zone here, the reason I put this idea of this flat part is, do we really know socially that there's a big deal difference between a 2% inflation rate and a 3% inflation rate? And the answer is no. We don't have anything to suggest, gee, if they had set it at 3%, life would be dramatically different. And it's one of the reasons why the markets are responding to everything that comes out with the CPI. It just came out a couple of days ago. And what that's really about Okay, it's all about short-term trading and determining what's going to happen with interest rates going on in the future. But here's the reality of the situation. You're a board member of the FOMC. You know, if you push up interest rates, you could push the economy into a recession. And in fact, all the economists at the Federal Reserve told you 2 years ago when you started raising interest rates. They told you, you're going to do this. Odds are you're going to create a recession. Larry Summers was out there saying it's going to be a recession for a year and a half, blah, 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 blah. Well, that didn't happen. We can have a macroeconomic conversation regarding what did they do right to be able to drain inflation out of this system without generating a recession. Well, now ask yourself the following question. So you got the information in front of you and it says the inflation rate is 3%, not 2%. You really willing to generate a recession and cause unemployment and the havoc associated with the recession for 1 percentage point of the inflation rate? No. So watch. This is an extraordinarily successful program, and it is a classic example of two things. One, we haven't lived through a pandemic for a very long time. You'd have to go back to the 1918, 1919 to understand. And the data back then just is nowhere near as good. So you think about all the models they build, they're analyzing data all over the place. Well, how many of the historical models do they have a pandemic information and how humans have responded to a pandemic? The answer is we haven't. And one of them, for example, was the supply chain crisis when it was happening. We got the videos of all the boats off the coast of Long Beach, and they were all stuck. And what was that about? That was in part about humans who were stuck at home during the pandemic. And by God, they're not going to go anywhere. There's a lot of other people. They're not going to go to the masseuse. They're not going to go to services. Well, they had cash. The federal government was feeding them all kinds of cash in terms of the bailout. What did they do? They bought durable goods. And where did the durable goods come from? China. Loading the boats up. And that was and you had workers down there that weren't willing to go to work. So you had a whole bunch of things you just can't predict were going to happen that were contributing to supply shocks where suddenly you go to the store and the shelves aren't there and people are getting upset. It's very different. People will be studying all these different factors that happened this time that weren't particularly predictable. But the real point is, okay, so the higher interest rates haven't slowed the economy down, but they have been able to drain inflation out of the system. There isn't a single model out there that would tell them that was true. Not one. So what is the concept? As I think some of you may know, economists, we like to have acronyms. And the acronym is called NAIRU. NAIRU is the non-accelerating inflation rate of unemployment. What is that all about? The idea is, okay, at very low unemployment rates, if you try to maintain low unemployment rates, the markets are so tight that businesses have an incentive to raise their prices. And if you keep the markets really tight, it'll just keep going. And inflation will accelerate. We witnessed some of that in 2021 and 2022 in terms of what was going on in terms of how goods and services were priced. Okay, so optimal policy, believe it or not, going back to this diagram, what this gray area is really about is, based on what we know and what we can measure, what is the unemployment rate that is consistent with inflation and the inflation rate not changing. Notice I said the inflation rate not changing. That means, you stick around here and you get close to the target, you pretty much stay at the target. Well, you're going to see there's 25 years of data to show that following that policy was wildly successful in terms of doing that. And it becomes a reference to the overall consequence of the setting of interest rates. Because how the Federal Reserve, how the 12 voting members of the FOMC interpret what's going on, they're looking at the unemployment rate below 4% with interest rates at 5%, going, we don't have a single model that would tell us that the unemployment rate would have stayed at below 4%. And so they look at a lot of different indicators to try to figure out when can they start bringing interest rates, when can they start bringing interest rates down? And the answer is they don't know. And the basis for it is pre-pandemic history. Pre-pandemic history measured with the unemployment rate on the axis and the inflation rate on the y-axis. What is this all about? Well, it is known as the Phillips curve. There are conferences on the Phillips curve to this day. There are conferences on the Phillips curve, and quote unquote, whether or not it's flattening. And one of the reasons they see this is, you see this part here, gee whiz, what is going on in the system? Gee whiz, we have higher unemployment rates, but the inflation rate doesn't come down. But when we have lower unemployment rates, such as what happened at the end of the 60s, the inflation rate goes up. And this line here represents, this goes out to the third quarter of 2022. And this is the statement. This is the evidence where people said, gee whiz, the Fed had this information. They should have acted faster. They should have raised interest rates sooner. And sure enough, yeah, well, one can make all the arguments about what they should have, could have done. They certainly could have raised interest rates sooner. And people will ask, okay, what is the cause of the inflation rate? And as an approximation, I can grant you the following approximation, for which there is no paper that I can point to go read. It's 1/3 because the federal government continued to stimulate the economy when it didn't need to. It's 1/3 the Federal Reserve didn't raise interest rates sooner, and it's 1/3 supply side shocks. The pictures of the boats offshore pretty much had a fairly dramatic but short-term impact on price level. Yes. Oh, this guy. This particular increase in inflation that led to the 1970s, which then led to the oil shock, it's impacted all macro economists. You don't want to get into this kind of situation, because the costs typically, as you'll see, the costs of getting and reducing inflation are typically significant. All the higher inflation periods in the US economy were succeeded by recessions. That's how we drained inflation out of the system. And how did they get there? Well, the Federal Reserve raised interest rates and drained inflation out of the system, which, weakened markets because people became unemployed and they didn't buy as much. And that led businesses to not raise prices as quickly. But there's a cost of that. Recessions are not free. People lose jobs, they lose income. There's all kinds of consequences to it. And because we haven't had a recession, people have forgotten what those consequences are. I assure you, Joe Biden understands it. So you look at this one. This is the 1969 curve. This is the heyday of macroeconomics in terms of what was happening at the end of the Kennedy administration and the Johnson administration. And the story is, the Vietnam War was really kicking. The unemployment rate was quite low, and Johnson did not want the politics of raising taxes to pay for the war, despite all of his advisors saying you've got to. And inflation broke out, and it continued. We're not going to go into the whole history of inflation, but it led to what happened in the 1970s, consequences all the way through the 1970s in terms of interest rate. Okay, and this is what happened in 2009 through. One would argue that this curve seems to be what this is an area of academic research, because it gets into the structure of the economy. If businesses are prone to raise their prices when the unemployment rate is high, it kind of makes sense. And if you open any macroeconomic textbook, and look at what they say to the macroeconomic students, they say, oh, well, you know, the unemployment rate gets really high. That's going to lower the inflation rate. And well, it didn't. And there's lots of reasons why that may or may not happen, but it's still in the textbooks that it's supposed to. And this represents what happened. What's interesting about this one is the fact that it stayed low for so long. This is 2021. The shock to the economy was in the spring of 2020, and it was only then, this is when you started seeing the videos of the shocks. And one really good economist at Harvard on a podcast said, we all got it wrong. If you look at, let's see, this would have been the inflation rate at the end of 2021 in terms of what it was being reported to be. And you look at the forecasts, there's something like 60 different forecast groups out there that you can follow if you want to. The Federal Reserve Bank of Philadelphia publishes the stuff. Blue chip forecasters in terms of, you know, what's going to happen next year. None of them got close. None of them. And that means the economists at the Federal Reserve didn't get close because they're using the same kind of models. Yes. Yes, the unemployment rate now is, I think, about 3.8, 3.75%. That's basically full employment. That's basically a statement. There's always going to be some turnover. So it's basically a statement that anybody who wants a job can get a job. That's right. It's assuming they're qualified. Yes. That's the full employment for years. They've just loosely full employment's the reference rate is usually somewhere around 4%. During the 70s, it seemed to be a little bit higher, so on and so forth. The Congressional Budget Office publishes their estimates of what is called NAIRU. You can download the time series. But the thing about the unemployment rate and how it's calculated is there is a monthly survey of 60,000 households every month. And so there's certain kind of consistency in terms of learning by doing. They answer, they learn how people answer the question. Are they answering the question that we're asking? Are they answering the question they think we're asking? All of that stuff is really important. So what you see in terms of what it tells you, it is a metric of the overall economy and its use of resources. And the implications to policy, to interest rates, to stock markets regarding when it's outside that zone between the unemployment and the inflation rate. And that's why I teach it. And this is these purple ones are the ones it's coming down on the other side. And the only other time that happened was in 1947. Typically, what a recession is, first of all, in terms of how is a recession defined, believe it or not, it's a group of economists at the National Bureau of Economic Research and it's called the Dating Committee. And the Dating Committee meets and says, this is the quarter when the recession started. This is the quarter when the recession ended. Okay. And that determines, that's the basis for these gray zones in this graph here in terms of they're the Dating Committee. And what is it highly correlated with? Negative growth of GDP for 2 quarters, but it's not the only thing. So what it leads to is shrinking the economy, leading to higher unemployment, okay, and reduced employment. Employment goes down, and the unemployment rate goes up. Those 3 things are highly correlated in macroeconomies. They always have been. They always will be. It's just about which one do you use in terms of reflective, in terms of how bad it is. And so it's useful to understand these 3 things in terms of how they play out. Because why? Because how they're playing out is reflected in policy that determines interest rates, and interest rates determine your personal investment strategy. So it is literally the macroeconomic policy connection to personal investing. And it's not just because I'm a macroeconomist, but I like teaching it in a course in finance. And here is another example. We just plot the inflation rate over time. And this is in answer to your question about recessions and inflation rates. The gray zones are the officially dated recessions going back in time. We have not repealed recessions. There will be a recession in our future, I assure you. But look at this. Look at how, gee, it peaked. It peaked. It peaked. It peaked. It peaked. It peaked. Yeah, that is telling you something about, and I mean, this goes back to 1960. This is telling you something about how extraordinarily complicated dynamic economy with all of the changes that we've all witnessed in our lives going back to 1960, technological change, you name it, okay, in terms of dynamics. And look at how consistent this little piece is and why this one is off the charts. Because why? Because the inflation rate, the inflation rate's coming, the inflation rate's coming down, and there is no recession. Now, there's another point of this graph. And this point of this graph is these are the inflation rates. Remember in the end of the 70s, this is where Paul Volcker raised, this is where you saw interest rates of 15% and so on and so forth. I mean, inflation was really high. It's just amazing, the story, what he did at that particular point in time. And one of the things that happened in the early 90s, New Zealand central bank came up with a targeting procedure, an operating procedure that said, we're not going to hit, we need to have inflation targets, but we're not going to hit it every month. And we should guide our interest rate policies. When inflation creeps up a little bit, we'll raise interest rates a little. It's micromanaging the economy. I assert this red line, when the Federal Reserve started instituting targeting procedures first on an ad hoc basis and then instituting it on an official basis. These are vastly different experiences in terms of what we've experienced. And if you just take the average of what the average inflation rate is in this red period, it's like 2%. It's an extraordinarily successful macroeconomic policy that, well, I'm sure they've explained targeting, but they don't get out there and do the rah-rah and saying, guys, this is an example of the government through the central bank doing something that has made our lives better. And it's this operational targeting procedure, which they borrowed from a central bank in New Zealand, which is a famous story among the Fed watchers. But it's believe it or not, it's incredibly successful. And there's nothing like success when you're in a world and you're making policy, it's having consequences all over the place. So there's nothing like success to get you to a point where you say, why don't we continue it? What's wrong with success? And I assure you, this policy is going to succeed because it's going to be continued until they're shown things have changed and it's no longer working the way it had before. But this gets attention inside the Fed in terms of operational procedure. And it's just one of the reasons I show this is I assert you don't have to do a lot of statistics on the difference between this black line and this red line. This red line is, for the most part, it's wiggling all around, up and down. This was 2008, where we actually had a very 1/4 measure of deflation, scared the living daylights out of everybody. Okay, and it wiggles around, and so on and so forth. Now, targeting is not Keynesian policies. What would be classified as Keynesian policies is that the government can intervene in the economy and make our lives better. That's the essence conclusion. And one of his big deal in the 1930s was, of course, deficit spending. That in fact the government through the federal government through deficit spending can improve the economy, and virtually at some level most of the advanced economies are pursuing that kind of policy one way or the other. Yeah. Yeah. Uh, oh, yeah, and just so you know, the question is, what are they responding to in terms of signaling the inflation rate? And they're economists. They're going to look at multiple measures of inflation rates because they don't all give you the same. They don't all give you the exact same measure. The Federal Reserve does. I do. The CPI is, they call the CPI the headline measure because that's the one, media and the public pays attention to. They look at the inflation of real wages and all the rest of that stuff as well. Okay, so if you look at all this, you say, hey, this is pretty good stuff. They did a good job, and this is why this getting out of hand. Ultimately there'll be papers and research. Should they have raised interest rates sooner? My going in position is sure. Sure, they should have raised interest rates sooner. They were a little slow, and they've been criticized among economists at various conferences that occur. They get criticized. You should have moved you had enough information at the end of 2021 to do something, and you should have, but you didn't. Okay, and you heard the term transitory. Okay, that got a whole lot of political play in the media. Oh, inflation is transitory, and you know it's you get hoisted on your own petard when you start using terms like that when you really don't know whether or not it's transitory. And the answer is, well, as it turned out, it wasn't as transitory as they claimed, but it's been relatively transitory from the effect of how the higher interest rates have been able to move through the economy and drain inflation out of the system without generating a recession. Yeah. Okay. Okay. So the question is Powell likely to make a mistake? And that's a question that you, of course, can they make mistakes? Of course they can make mistakes. But I know what their philosophy is right now. And their philosophy is right now is, given how well the economy is doing at 5%, they don't have to lower interest rates to generate one of their dual mandates, namely the economy is performing better than anybody hoped. Economic growth is higher than anybody predicted. The inflation rate's coming down faster than anybody predicted. And one of the things they'd be concerned about, that if they reduce interest rates too quickly, inflation could rear up again, and they really want to get it out of the system as much as they can. And if you based on what they know, they think that's kind of a 1 to 2 year plan. And my guess is that's the plan they're going to follow. And could it be wrong? Absolutely. There's so many things that can happen to throw you off that particular strategy. But the real point is, based on what we know now, they're going to get a lot of kudos because they pulled it off. It's not just a soft landing; it's a landing. Yes. Yeah, they're blending. Put it this way: they don't want inflation to go back up, so they're going to be conservative. And if they hold interest rates where they are for another few months, is it really going to make a whole lot of difference? The answer is no. No. And if they reduced interest rates, could they, could they fire up the economy? And the answer is yeah, but the economy's already fired up. You wouldn't know that from the polls in terms of how humans react, but in terms of how people do not understand inflation is an inflation rate. It raises the price level. So the price levels have already come up. And in some cases, like food and energy, price levels may go down. But an awful lot of stuff, we're not going to have a deflation. So an awful lot of things are going to be permanently priced at higher levels than they were priced in 2019. And it takes the humans, all the people interacting in the economy, it takes some time to learn. Well, as a matter of fact, prices really haven't gone up for the last year. Marking it today, you go the last year, you go, yeah, it's higher. But a year from now, they won't be saying that. So there's learning by doing. And this is one of the reasons I do data, okay, and look at data, is because the data actually tells the story. Okay, well, one can get into academic debates as to what the data actually says, so on and so forth, but just look at the data in terms of what it is telling us, which is the reason you don't want higher inflation is because the public doesn't really want higher inflation rates. The policymakers don't really want higher inflation rates. And if you let it get out of hand, you're going to generate a recession in most cases. And recessions are bad things too. There's no question about it. So, and it's this history, and models fit to this history as to why economic forecasters thought, well, they're going to get inflation out of the system. We're going to have a recession, and we're not. Okay. The next concept. Oh, it's break time. How long a break you guys want? 10 minutes. Okay. It's okay. We'll start off at 8 after. How's that? Mm. The assess part really should be based on the earnings on which talk about. There we go. I think everything's on. Let's talk about real interest rates because this is what the Fed looks at, believe it or not. And what are real interest rates? Real interest rates are those interest rates adjusted for inflation. So the rate on the rate, 3-month treasury rate is the rate on the issued treasury rate. But if you subtract the inflation rate, you find out what's happening with real and what's happening with real interest rates. And wait a minute. This is what I want. And so this is the Fed is very much in tune with following what's happening with the overall inflation rates and where nominal interest rates are relative to the inflation rate. And you can see that typically when the real interest rate is negative, that's not deflation. It's the real, that just means the inflation rate's higher than the interest rates. That tends to be stimulative because borrowers understand inflation and they understand the cost of borrowing, and their expected inflation rate really matters. And so what it does is its policy is to try to raise real interest rates, which is here. This is just the Fed funds rate minus the inflation rate. This is what they tried to do and what they succeeded in doing in terms of trying to slow down economic growth. So as the inflation rate declines, the real rate, even though the nominal rate may not have changed, the real rate is potentially increasing, and they have models to tell them, oh, we got to be really careful here. We don't want the economy to slow down from here. Okay, you'll see in a minute why this is important. Okay, so if you look at this in terms of how it looks, you've got the inflation rate, you've got the Fed funds rate in terms of what it's motivating, and you've got the real Fed funds rate. And most people don't look, they don't go to spreadsheets and take out what the real rate is. It's not published. This is published, but this one you pretty much have to calculate. You pretty much have to calculate it to see what it is doing. And in fact, this is the Fed policy. In the spring of 2022, they started to raise interest rates because they were concerned about the higher inflation rate, and they raised it faster, faster than the inflation rate. So the real interest rate increased, and as a result, the inflation rate came down the way it was supposed to. There we go. And this is the puzzle which we've been talking about most of the class today. The puzzle is that they did it in terms of the inflation rate and the real growth rate, and they did it without. The idea was, gee whiz, this guy was going to have to go up significantly, and this guy was going to have to go down significantly, and neither happened. And we're better off and lucky that it didn't. So, what are the conclusions? Higher short-term interest rates. Short-term interest rates are the intersection between macroeconomic policy and thinking about interest rates. No question about it. And in turn, that policy has a significant impact on the rate of inflation, et cetera, et cetera. As I've said, the puzzle is why the labor market continues to outperform. We still don't know whether a recession will occur, but we do know if one does begin, the Fed's going to reduce interest rates in response relatively quickly. Okay, so we've gone through this list of interest rates. Interest rates are, economic agents, individuals, corporations, they're all interacting at one of these kinds of rates. This is the one I forgot to take out, but it's too late now. We've seen this curve before. Okay. So the next topic is, what does it mean that the Fed is paying interest on reserves, and why should anybody care? Well, it turns out, and this is something that I only learned from a podcast a couple of years ago. It turns out the interest the Fed is earning on its bonds in its vaults is more than it needs. It almost always has. And so the Fed remits, it has a budgetary process, and then it remits its excess funding back to the US Treasury. What's wrong with that? Well, they're now paying interest on this, and it means the interest rate is being determined by the FOMC, who is paying the interest that is going to the largest banks in the economy. And the answer is the US Treasury is. Why? Well, because it's reducing the remittances that the Federal Reserve is paying the US Treasury. So it's not coming at a cost of the Federal Reserve's budget, it's coming at a cost of the US Treasury. So implicitly, the US Treasury is paying reserves. And if you looked at the concentration of banks, you'd see that the biggest banks have the biggest reserves. And why Elizabeth Warren hasn't taken this up as a political effort, I have no idea. But it's useful to understand that these connections in our economy and the operations of the central bank have all kinds of influences and impacts and things. And until you see them implemented and how they play out, there's just lots of different consequences. The other thing to note is this is what the Fed decided not to do. It said, we don't want negative interest rates. Well, this is I just pulled some short rates and some long rates out of different countries to show you that, in fact, they've had negative interest rates for quite a while, with Switzerland having the most negative of any of the countries that I pulled. Japan is the next area. The next one is the Euro area in terms of how they do it. How do they implement? If you do this to depositors, you know what happens with depositors, right? That if the bank said, give us your check, we want you to give us a checking account, and in a year I'll give you back 90 cents on the dollar, what would you do? You'd say, well, I'll minimize the amount of money I'm putting in the bank, and meanwhile, I'll put the cash in a vault, which is, of course, it's called disintermediation, and you don't want that to happen. So my understanding of deposit rates throughout all of these different economies is it's not going all the way. The deposit rates extremely low, but they're not going negative. So the consequences is this. This is the piece that the interest and reserves is paid by the U.S. Treasury through reduced remittances on it. And I'm going to show you how they did this. This is the piece, the quantitative easing, who is paying interest on reserves. This is how they pursued the interest. This is just the lines of the graph that you've seen before in terms of the size of their overall position. And why they did it is because the policy adopted is we don't want negative rates, which means we can't lower interest rates as much as we want to stimulate economic growth. So we're going to throw a bunch of cash into the economy. That's quantitative easing in order to provide some stimulus to economic growth. And all you have to do is look at the past when they had more opportunity to lower interest rates without going negative. In every case, they lowered the real interest rate by a lot. Fiscal policies, with one minor example, fiscal and monetary policies work together as soon as the recession came to try to stimulate economic growth. Okay, and the Great Recession changed everything, because the Great Recession all you have to do is look at the real Fed funds rate. It hit zero. The Fed funds rate hit zero in December 2008. They couldn't lower it anymore, which means they couldn't get the stimulus from lower interest rates. So they had to find another way. The deficit was stimulating economic growth, but not lower interest rates. Constrained, it's called the zero bound, and they were constrained by the zero bound, and it has been influencing returns on all kinds of things, including the pension funds, which we looked at before, for quite a long time. And what is this about? Well, it's the consequences of politics and what happened during the first part of the Obama administration, which was he decided to go for Obamacare. He lost control of Congress. And the assumption in the early part of the Obama administration was they could get more fiscal stimulus if they needed it. And they didn't, because of politics and because Republicans in Congress did not want to provide that stimulus. And here is where you really see it. Larry Summers, very, very famous economist. He was in the Obama administration. He wrote a briefing memo, which I got a copy of. And he said to Obama in early 2009, it is easier down the road to insufficient fiscal stimulus than to subtract it from excess fiscal stimulus. We can, if necessary, take further steps. That was the assumption. And they lost control over Congress in 2010, and it didn't happen. And all you have to do is look at what occurred. Here's 2010, and look at this. The total government purchases of goods and services, the federal government, the state and local governments, it actually went, the economy was weak, and these purchases were going down. So the stimulus in the economy is from what do they purchase? What are they buying? And they're buying less goods and services in real dollars over time, which means the stimulus is going down. And this is the explanation. It's in the Federal Reserve reports in terms of what really happened, the fiscal stimulus weakened, and while the unemployment rate continued to come down, it took a long look at how long. This is from right around here, June 2009, the peak of the recession. Look at this. This is several years of very high unemployment rates. That's a lot of that's millions of people suffering, not being able to find employment, not getting income, not liking things in the not liking outcomes in the economy, and it goes right up into December 2015, and that's the story. The fiscal stimulus wasn't enough. They needed to put more fiscal stimulus into the economy, given the size of the Great Recession. They didn't, and in turn, what that does is you just have to look at, well, what happened in prior recessions versus the Great Recession, and you just look at this and you just say, what do you know? This is GDP underperformed, didn't grow as fast as it did in other recoveries, and this is the employment rate, which goes below it. The economy did not grow as fast as one would have expected to based on history. And one of the reasons was because the federal government tightened its purchases of goods and services. And this is the key. This is the Fed turned to quantitative easing policies, but quantitative easing policies only work so well. Yes. That's putting that quantitative easing is writing checks and buying bonds, mortgage-backed securities and treasuries to by trillions of dollars. That is quantitative easing. That is what they did. There's some minor differences in different periods as to what they did, but that's quantitative easing is the Federal Reserve writing checks to stimulate the economy. And this is why they did it. The economy needed additional stimulus. It didn't get it. The Federal Reserve's mandate says your job is to try to keep the unemployment rate low and try to keep the inflation rate low. The inflation rate was doing fine. So they adopted quantitative easing as an innovative policy. And this is the graph. This is the manifestation, which you've seen before. This is the manifestation of that policy. This policy occurred because they adopted the zero lower bound and decided they didn't want to go negative. And the politics changed in the federal government, and you didn't get the fiscal stimulus after you hit the bottom of the recession in June 2009. You didn't get the fiscal stimulus. It's starting to tighten things up. So they said, our job is we got to stimulate stuff. That's right. Well, actually, I don't have a graph of the dollar, but it's if you look, that was part of a lecture that we're not going to get to in this course. But there's no question that in fact putting money out there affects the dollar, but it doesn't have the huge effect that you think it does. Otherwise, you would have heard about it. You would have heard about dollar crashing, declining by lots and lots, and on a trade weighted basis. It fundamentally didn't. This is why they do it. This is the whole idea of quantitative easing, and why they did it was, well, they're looking at this is the data. This is the Fed funds rate. This is what's called the yield curve spread. This is the short-term versus the long-term rate. And this is the spread between the long-term rate mortgage rates. Mortgage rates are not, they're priced off the long bond, but they're not it's called the basis. And that varies a good deal. And their idea was we want to keep long-term rates as low as we can, and quantitative easing, putting the money in there keeps longer terms, and that helps stimulate economic growth because lower interest rates help grow the economy. That was the idea. And you just look at the data and you raise the question. It's called bang for the buck. And the bang for the buck is, if you look at the studies, yes, they think they did have an influence over the interest rates, that they were lower than they otherwise would be. But you just look at the level of assets and how much they may have gotten in it. And you say, well, maybe it was 1%. It matters. 1% matters a lot. But look at the trillions of dollars they had to put into the system to potentially have that impact, if in fact they did have that impact. I mean, the real question is, what would mortgage rates have been without quantitative easing? And those are the experiments in a national economy. You don't get to run that. You don't get to run that experiment. You can't rerun history. And so the real question from all of this is, it is the intersection of policy decisions that, for the most part, the public is not paying a lot of attention to. They don't, when I've taught a finance class on how do negative interest rates work, I have a really good example. The German government issued a sovereign bond, and it had a zero coupon on it. This goes back a few years. A zero coupon, I think it was a 10-year bond. And in the marketplace, it got a premium. People were willing to pay up. Buyers of those bonds were willing to pay over its face. So they didn't lose money, but they earned no interest. They got the face value back, but they paid more than the face to get it. That's a negative interest rate. And that's how they work. Yes. Oh, the question is, could Congress have voted against quantitative easing? And the answer is, Congress has enormous power if it chooses to use it through passing laws and things like that. Could they have passed a law that said, I'm sorry, you cannot do this, there was some constraint? And the answer is, sure, they could have. And were there members that probably wanted to? Sure. Yes. Yes. Was there no question? You're okay? You okay? Okay. So that is, why did we have quantitative easing tied to not wanting negative interest rates and this thing that economists spend time talking about called the zero lower bound policy? There's one more concept for today, and that is called R star. R star is known as the natural real rate of interest. And like a lot of things in economics, you can talk about it. Measuring it's a whole different thing. The idea is, in the magical world of a full employed economy, there is some real interest rate there consistent with the equilibrium of this entire economy. And it turns out the former head of the Federal Reserve Bank of San Francisco wrote a paper in 1993 using a very complicated academic model estimating R star. He happens to be now the president of the Federal Reserve Bank of New York. This is John Williams, and his paper's gotten a lot of attention. They got websites at the Federal Reserve Bank of New York devoted to the concept. But the real question is, why am I telling you this? Why should you care? And the answer is, why should you care is, if the equilibrium real rate of interest is declining for whatever reason in an economy, that means interest rates in general are going to be lower than they otherwise would be. And if you look at this is the same graph as you looked at before. This is the 3-month Treasury rate to illustrate how you calculate the interest rate. Well, you can look at interest rates across all the advanced economies. These are short-term interest rates. And lo and behold, this is US, Germany, UK, Japan, Switzerland, and Euro. And interest rates have been in this long-term decline going back 30 years, raising the question, the reason why long-term interest rates have been going down is because our star is going down. So it's easy to describe what it is, but measuring it's a whole different kettle of fish. And what it means is exactly how you measure. It's very sensitive to modeling assumptions. The models that they're currently using, if you read, I know you're anxious to read these papers. If you read the papers, you'll see the term posited parameters. What are posited parameters mean? Made up parameters that fit with, some expectation of what its value might be. These models are high, they're very complicated algebraic systemic models. And who knows, but I know this. If the FOMC believes that R star is a relevant measure, if the FOMC believes that the real natural rate of interest rate is lower, which they do, if they think it's going to continue to be lower, it is a guide to what is going to happen to interest rates over more than just a short. We're going through a cycle now that they raise the rates are going to come down. What people don't realize, if they really believe R star is much lower than it used to be, that means from the perspective of where interest rates are going, is they're going to come back down. Whether they get all the way back down to zero or not is another story. And we're only going to find out, over the course of the next couple of years. And what it means is, okay, there's potential for negative rates again in the future. They're going to follow the zero lower bound policy. How does this affect quantitative easing? They might be holding even more bonds. There could be a recession at some point in the future. We have not repealed recessions. And what this is this is their estimate of R star. They have it for Canada, Europe, and the United States. And what's interesting about it is you take the estimates from the model and you run it across. If I can get this thing to change. You run it across. Remember this guy, the real interest rate, and you say, where is it? And you say, what does that say from a standpoint of modeling? Well, this is the actual real rate. This is one I've shown you before. This is their estimate. This out of the New York Federal Reserve of what R star is. And what it implies is, if that's a guide to policy compared to where it was going back to 30 years ago, if they really believe in this, then you're talking about potentially returns to lower interest rates, not generated by a recession. And what it's about is there are cyclical impacts on interest rates, and there are trend impacts on interest rates. We are now going through the cyclical impacts. We had higher inflation, the Fed's raised rates, barring some other kind of shock or some terrible news event or something. The general view is interest rates are going to come down. What people haven't really realized is when they come down, they're going to stay down if this hypothesis is true, because you combine the real interest rate with the inflation rate, and you get yourself, by definition, through arithmetic, you get yourself a very low interest rate. And it's worth thinking about in terms of how you think about managing your own position, as to, how do you really think about this, so you're not surprised 2 years from now. You go, I remember this, I took that course, and I won't be surprised if interest rates come down and stay down and the economy is doing just fine. We'll find out. And that ends today's lecture. We made it. We made it. There's a lot of material today, but we made it. Just so you know, the next 2 lectures, that's the hard stuff. The next 2 lectures are the last 2, and it's about why do we have federal regulation.